Mark Matthews of Bank Julius Baer and Company is now joining us for some chit-chat on markets. Mark, great to have you with us here on CNBC-TV18 as always. Appreciate your time. Pretty dramatic kind of price action, Mark, over the last 5-6 days, especially U.S. yields retracing big time. 2 years down 40 basis point, and the dollar is down almost 4.5% in that same period. As I was saying, many are now kind of coming around to the fact that maybe the U.S. will skirt a recession and it'll be a soft landing. What does it mean for equities in general, Mark?
It's a positive, of course, and the market is always looking forward. And so it has factored some of this in for sure, because now it's thinking about what is December, what is January going to look like. But the good news is I think that things will be good then too. And the earnings, which we've just entered, of course, the results season, will be their worst in the second quarter, and they'll improve after that. And the language coming out of the companies that report their results will be closely watched, of course. But my sense is that, and the 5% of S&P companies that have reported so far are far too small a number to gauge. But my sense is that companies will be more optimistic on the economy than analysts had anticipated. And therefore, we can continue to rise. I think that the remainder of this year will close on the 31st of December higher than where we are now.
Oh, okay. Are you talking about higher than where we are now just for the U.S. markets, or do you think that could be the case for the Indian markets as well? Because it's already been an 8% rally since the start of the year for the Nifty. Do you see more upsides?
Yes, I do. And in fact, this positive momentum is something which was very concentrated in a small handful of companies up until the end of May. But since then, we've seen a broadening out of it. I should say, not just in the United States, but of course around the world. You've seen emerging markets, as you rightly point out, India, start to participate in a rising market, which it wasn't really doing in the first half of the year. So I'll just give you one statistic pertaining to the S&P 500 index, which is that back in March, only 16% of the 500 companies in that index were trading above their 50-day moving averages. And as of Friday, that number had risen to 82%. And if you look back in history at when 80 to 85% of S&P companies were above their 50-day moving average, the returns 12 months forward were higher on average by 85%. And on average, the S&P rose 12% over the 12 months that followed those kind of periods that are similar to where we're in today.
Mm-hmm. Hi, Mark. Good morning. What about the Chinese markets? There's talk that a big stimulus is coming, and going by the data points, maybe that's required because data coming out of there continues to not look very, very great. Your view on the Chinese market from here on?
Yes, there's a critical meeting coming up at the end of July, which is their Communist Party Politburo meeting. There's always the risk in a command economy like China that you can see them suddenly put the pedal to the metal and announce a very large stimulus. But there's no indications that we can gauge that show that will be forthcoming. So they are tweaking things at the margins. But the main problem, I think, is that they're trying to get banks to lend more. And credit officers are reluctant to do that because they're worried that in the future, they might be held responsible for having approved loans that turn sour. And so I don't see meaningful stimulus. I see tweaking, as I said, at the margin here and there, but I don't think there's a big one coming.
I think we've got the GDP numbers for the quarter out of China just now, and I think there's a slight miss, but maybe the market would have liked a bigger miss, right? Because that will get at least hopes higher for a bigger stimulus. And I mean, this is neither here nor there in that sense. Mark, in terms of, risks really going ahead, as you said, the market is looking out, right? I mean, a few months out at least. What could it be, in your opinion?
Well, I think the risk is that we're all assuming inflation will continue to trend down. And if the Cleveland Federal Reserve does what they call a inflation nowcast, they aggregate 10 high-frequency data to tell us what the current month's inflation will be. And they're looking for 3.4% headline CPI for July, which, of course, is higher than the 3% we saw in June. Likewise, even if you assume month-on-month inflation is zero, which I think is unlikely. I think it will be higher than that between now and the remainder of this year. You're not going to get headline CPI at 2%. The lowest it'll get to, if you assume that sequential inflation trundles along at zero, is 2.4% by October, but then it would lift up to about 2.8% by January next year. So I guess the concern is that what if inflation just sort of sticks at about 3%? And will that be enough for the Fed, who say that they are intent on getting to that target that they established back in 2012 of 2%? That's a problem, because I don't think we can get to 2 in this. 2% made sense in 2012. It doesn't make sense today. There's too much that's changed.
Okay, all right. Well, Mark, we don't have too much time left, but thank you so much for joining us and speaking to CNBC TV18 as always. Appreciate your thoughts. Have a great week ahead, and thanks for being with us on the channel. Well, that's Mark Matthews of Bank Julius Baer saying that the equity momentum is intact across most global markets and in our own markets as well. Let's take a short break. On the other side of the break, many stocks will be reacting to news flow. Avenue Supermarts will be top of mind, post muted set of numbers. More on that coming up in a bit.